Good morning, everybody. Thanks very much indeed for your time. So this is a presentation on our results for the 6 months ended 30th September 2021. Speaking today is just Stephen Cooklin, the CEO of Manolete Partners PLC, also the founder, as a chartered accountant, qualified in 1991. So what do Manolete do? Well, very fundamentally, we buy legal claims from insolvent companies via their liquidators or administrators. We don't buy the company, we don't buy the debt, we're just buying the claim itself, what's called a shows in action. And this is unique to the world of insolvency, certainly in the UK. Other listed funders that you'll come across tend to fund someone else's claim, and therefore they're governed by very old rules of champity and maintenance, which means you cannot interfere in any material way with that claim. So you could see operationally why someone like Manolete is very attracted to insolvency, in that we can buy the claims and therefore have full control over the claim. And that is control of every step of the litigation process. Whether to issue the claim in the courts, it's only at that stage that both sides are exposed to adverse costs. Whether we approach the other side to mediate the dispute, as the vast majority of our claims tend to resolve using that method. Whether we just make an offer, could be what's called a Part 36 offer, or just a global settlement offer, whether to accept an offer from the other side, kind of thing that happens almost every day at Manolete. Crucially, when to abort the claim. So if you're funding someone else's claim, as other litigation funders do, you've signed a commitment to fund that claim, and it's very, very difficult to pull out, frankly. With Manolete, we own the claim. If we don't like the way it's going, we just stop. And that is obviously very important when you're dealing with a whole wide range of portfolio of claims. And then equally important, as we are the claimant, the legal advisors, solicitors, barristers, experts are all reporting to us. And us alone. We are the claimant, so we can control their costs. We can change advisors, very, very rare indeed. But that obviously gives us a very tight handle over the cost of these claims. And because of really all the factors above, 97% of our cases settle long before trials. Only less than 3% have actually gone to a trial. And the majority, actually, before we've even issued the claim in the courts, we reach out to the other side, they reach out to us, we sit down and we settle the matter on a commercial basis. That's what we're doing 90% of the time. In a very small minority of the time, we are funding, so we're acting like the other funders, but we are rather different in that we only fund insolvency practitioners. We're never funding a lay individual or a lay company. And again, that is important. IPs, insolvency practitioners, are very used to litigation. They're very sophisticated in litigation, and therefore they're a great partner to fund in those rare cases that we do fund. It's the Insolvency Act 1986 that allows us to buy the insolvent company claims. And what was really transformational for us was in 2015, we were then able to buy the insolvency practitioners' claims themselves. We'll come on to those in a second. The vast majority of our cases are from corporate insolvencies. A small minority relate to individual bankruptcies, and there we can only fund claims. As I say, it's very small in number. And that table at the bottom is interesting because I said over the years since we listed, we will trend towards more and more bought claims. So as you can see from FY21, so ended March 21, the completed cases, so the older cases, about 84% were purchased. The new investments that year were 90% purchased. And in the results we've released this morning, 94% of those in new investments in this 6-month period were purchased. So that trend is as we predicted. So what are these claims? We call them the 7 deadly sins. So first 4 are company claims, and these are the typical kind of cases that just repeat and repeat, all UK claims. at Manolete. So the first is an unpaid director's loan account. A lot of directors, certainly of SMEs, run their lifestyles through their businesses. That's fine as long as at the end of the year they repay those loans or they declare a dividend. And that's fine. But obviously, when a company's become insolvent and that loan is outstanding from the director to the company, that is a debt due to the company. And there are many claims that we look at that way. I would add as a footnote that we're seeing an awful lot of the COVID loans going in as directors' loan accounts, and then the company being put into insolvency. So expect that to be a very busy period on that going forward. Secondly, there's breach of duty, misfeasance claims, and this is as much under the Companies Act, actually 2006, as the Insolvency Act. And fundamentally, a director needs to act in the best interest of the company when it becomes insolvent, or of doubtful solvency, in the best interest of creditors as well. So obviously, any monies to the benefit of the creditors taken from the company is questionable, and legality of that is under question. You've then got breach of contract, which is where maybe a customer hasn't paid at the time of insolvency, and very often customers think, oh, the company's gone bust, we don't have to pay anymore. But that obviously is wrong. That's a debt to the company, money's owed to the creditors. Or it could be a supplier that maybe even caused the company to go into insolvency because of faulty supplies. And then you've got the unlawful dividends, very strict liability on this. And this is where, if you haven't got the retained profits or unlikely to have in the future the retained profits, you cannot issue dividends to negate those unpaid loan accounts in number 1 above. So again, a very a busy sector for us, and always has been. You've then got the insolvency practitioner claims, the main heads of claim here under the Insolvency Act. And these are not the company's claims, these are claims that arise in the name of the administrator or liquidator. Before October 2015, we couldn't buy these, but happily there was a law change that we pushed very hard for. So transactions that are under value. So a company is having some problems. It's maybe taken on too much debt. The director, owner, manager sets up a new co, transfer the business into that new co, leaves the old debts behind, maybe very big tax liabilities, for example, and hasn't paid a proper price for that business. We see this an awful lot. The net numbers tend to be really quite large. So that is a TUV, transaction at undervalue. Preference claims, very often families get involved in financing SMEs, money's owed to fathers and mothers and uncles, etc. And kind of morally, understandably, when insolvency is looming, the directors tend to prefer the payment of the final monies in their bank account to family members, but that they have, of course, broken the law there. They've got to treat all creditors, HMRC, their own staff, pension schemes equally. They can't prefer family members. And then finally, wrongful trading, which is where a director is personally liable for an increase in net creditors in the company if he or she carries on trading when they reasonably should have known that they should stop trading. So, as I say, these are the typical 7 deadly sins that Manolete sees in UK cases time and time again, almost every single day of the year. Why is it important and ethical? Well, for the insolvency practitioner, he has an overriding duty to maximise returns to creditors. So this is why these claims are ever so important. Under the Statement of Insolvency Practice number 2, SIP 2, the IP has to investigate claims, and if there is no monies left in the company, and there are often that is the case, he or she has to seek funding from an outside entity such as Manolete to do that. And in many of our cases, all those assets have disappeared, and therefore the IP really has no choice but to seek outside funding. The IP also acts with personal liability, and so really to have our kind of protection and finance around him or her in the work they do is seen as absolutely critical for them to get justice for creditors. And when you look at creditors, this is all back to the Insolvency Act to get some or all of their money back. Litigation is not their area of expertise, and they will very seldom finance any claims. HMRC is often a very big creditor, and obviously the HMRC is the kind of the bank of the government that funds the NHS, education, welfare, defence, foreign aid, etc. So the monies that come back into insolvencies from the work we do with IPs very often are going to HMRC, and that's why we really put this ESG point up there is certainly on this social and governance side. I think what Manolete is doing with IPs and their lawyers is ever so important. For my final point there, society at large, there are 4 million registered companies in the UK, about 500,000 new companies formed every year. And there are about 20,000 that typically are insolvent, and claims arise from about 2,500 of those. So we're dealing really with the bad apples of UK capitalism. And what you will find is a lot of the directors are serial misfeasant directors, often leaving quite a lot of local devastation to other local businesses. So before Manolete came along, IPs were working on a no-win, no-fee basis with lawyers. So if nothing was recovered, no one charged any fees. If something was recovered, they got paid double. And that sounds good in theory, an interesting theory, but as Lord Justice Jackson found out from analysing hundreds of thousands of cases, not just insolvency, in the UK, those costs of this no-win, no-fee and the associated after the event insurance, very expensive insurance product, was costing about up to 200% the size of the damages. So what the Jackson reforms, which came in fully in 2016, said that the costs of those no-win, no-fee and insurance had to come out of the damages. So of course that really is a hopeless situation for insolvency, because if the costs of those lawyers and that insurance company is 200% the size of what's actually recovered, then the money's just going to pay lawyers and insurance companies, not to satisfy the demands of the Insolvency Act to maximise the return to creditors. So our model is very, very different, very aligned with the creditors. Again, HMRC being the single most important one. We pay an initial consideration when we buy or indeed fund the case, usually about £5,000 to £10,000. We pay for all the costs going forward, which tend to be about just 10 to 15%. Of the actual cash recovery on the case. When we get a resolution on that case, we get our costs back first, and then roughly split the remainder 50-50 with the insolvent estate, the creditors effectively. And on larger cases, our share of those net proceeds slides in favour of on a ratchet in favour of the creditors. So for one case that's running at the moment, it goes 50-50 on the first 2 million proceeds. Over that, it goes 60-40 in favour of the creditors. Over 4 million, it goes 70-30 and stays at that level. So that's for particularly large cases. And it is that alignment with the creditor estate. The lower the costs, the higher the net proceeds, the higher the return for the creditors and to Manolete. So we are very much aligned fundamentally in the structure of what we've developed here. Whereas under CFA, no win, no fee, and AT insurance, the lawyers and the insurers are taking out of the gross recovery. There's no incentive to settle because, of course, if the defendant's good for the money, the more, why not bill more over years and years? And of course, that's to the detriment of creditors. So example here, I'll run through fairly briefly. So this is a £400,000 claim. I said the only creditor is HMRC. Within a week of the case coming to us, we'll have done our checks on whether the defendants have sufficient assets. We'll do the legal analysis. We'll make an offer that tends to be accepted, and then we'll pay that £10,000, for example, up front. Letters get issued to the defendants. They respond. More what's called pre-action correspondence ensues, but that can often then go on for years if one's not careful, and this is what happened under the no-win, no-fee regime. What we do is then say, well, look, we've listened to your arguments, we're not convinced, we think we do have a very strong claim here, and here's a draft claim done by a barrister. Unless we get a proposal, we will issue this, and 9 times out of 10 the other side will agree, at least at that stage, if not earlier, to a mediation of what's called alternative dispute resolution, which we sit down literally around a table and come to a commercial settlement. So let's say in this example we settled for 300,000. Let's say there's some good arguments. And typically we'll get paid a proportion of that pretty quickly. So here, 150,000 in 21 days, but then the rest, the directors need to raise money, selling flats, whatever, selling shares, etc. So let's say we agreed that the rest of it is paid 50-50-50 over the next 18-month period. We put at the same time a restriction or a legal charge over the directors' houses, and that is not released until we are settled in full, which is why we have such a good recovery rate on our claims. So how does this look in returns for Manolete and all the various stakeholders? So our costs to the lawyers, etc., 40,000. We pay 10,000 up front. So out of our pockets has come £50,000. We've got in 300,000. So less the 50 of the costs. So the net proceeds are 250. So our share is 125. The creditors 125. But Manolete also gets its £50,000 back as well, of course. So how does it look for Manolete? Paid 50, we get back 50 plus 125, so we get 175 back, a money multiple of 3.5 times, a return on capital of 250%, and that would be an IRR, because most of the costs come towards the end of a case progress, well over 350%. The creditors get a completely risk-free 135, so the 125 share of the 250, and the 10,000 they got up front, and that's all risk-free, and the personal liability of the IP has been protected fully, and the lawyers have been paid properly as the work has been done as lawyers rather than as risk takers. So a little source and application of funds here. There's the cash coming in from the directors. Creditors get 135,000, or the estate does. Manolete 125, and lawyers 40, adding up to the 300. Let's say HMRC, as we said, was the sole creditor for 400,000. Let's say out of the 135 that the estate has got, obviously there's insolvency practitioner fees. So let's say, for argument's sake, 100,000 goes to the creditors. So HMRC has got a 25 pence in the pound recovery in 18 months, whereas under a CFA, no win, no fee, they would have usually got no more than about a penny in the pound, and over a 4-year period. That's how long these other type models of cases used to run. So in many of our cases, we're turning, in fact, a zero recovery to creditors into a material positive recovery. One case that we worked on a couple of years ago, the creditor dividend was going to be just 4p in the pound. After we had supported the litigation, that had risen to 60p in the pound. So that really is very highly transformational returns to the creditors. And the trouble is, really, under the old model, as I mentioned before, there was no incentive to complete the case quickly if the other side was good to pay, which is why it took years and years, and all of it just disappeared in fees and insurance costs. Professor Peter Walton got his link there. The first report he did of 3 looked at 96 insolvency cases that were all being done under the no win, no fee regime. And after a 4-year period, 71 were still ongoing of those 96, and almost none of those that had been resolved had any more than a nominal return to creditors in there. There's a link to his work there. And that, of course, as well as to HMRC, there's an awful knock-on effect to local suppliers, employees, pension funds, etc. So this is now Manolete's track record over a long period of time, 12 years. So the first few years we're just kind of testing the model, but really the last 10 years is when we got serious backing behind it. And as you can see there, we've invested in 647 cases. We've completed over 400. Almost all of the earlier cases complete, just one left from 2017, none from the years before. The total investment in those closed cases, 15 million, total recovered 76 million. So total gain, if you like, of 61 million, and our share of the profit, if you like, on those cases, 25 million. And that's been done on a very consistently just 11.3 months, generating a 167% ROCE and 2.7 times money multiple, and a very healthy IRR. As you can see in that 2022 row there, already the 6 cases already completed in the last few months. Completed in just 3 months, so the IRRs have really become stratospheric, but obviously bigger cases will take longer to complete. Of the COVID situation, it created some very unique conditions in our market. So the government introduced some extraordinary emergency measures to suppress insolvencies in June 2020, the Corporate Insolvency and Government Act. And these were temporary measures to make it very hard to push companies into insolvency, so to protect employment in the UK, so almost wartime style legislation. The government had originally said this would end in December 2020. We had another lockdown, they continued. And so what this all meant was there was a sharp 40% decrease in UK insolvencies, as you can see from that chart. But in the last 4 months, creditors' voluntary liquidations, which is by far the biggest element of insolvencies, where we get almost all of our work, has come back very strongly indeed. And those temporary measures have now ended, 1st of October 2021. We're largely back to normal. There's a couple of temporary increases in the amount of debt, just £10,000 rather than really just a normal amount to issue a winding up petition. So that's to protect very, very small businesses, hairdressers, small restaurants, etc. But those won't be material. And also the property creditors can't do anything until March next year. So we are now well set for what should be a strong resumption of growth. An awful lot of parties are predicting a very strong rise in insolvencies over the next year or two or three. Prior to this emergency period, Manolete was growing very fast indeed. You can see in the graph on the right there, the number of cases every 6 months was going from 30 to 4 times that level. 110 cases in the first half of the 2021 year end. So we were really moving very fast. But then this emergency legislation came in, and as we very clearly flagged to the market, that has suppressed that growth rate. However, things are starting to come back. Bottom right-hand corner there are KPIs for September and October, showing a strong recovery. The number of inquiries was up to 50 and 55 against a low of 31 in March. Number of signed cases was up 50% and 80% in these last 2 months, from a low of 10 in August this year. Cash receipts are growing strongly, 25% ahead of last year against, a very challenging environment with people on furlough and businesses closing, etc. So the team has done a tremendous job there. So we would hope to see a resumption in the strong level of cases being signed, cases being completed, and then cash coming in from those cases. We only had 4 in-house lawyers at the time of the IPO. We now have 11, and we have the former chief insolvency judge, Stephen Baster, on our board, has been there for 3 years now. And they're led by Mina Horton, who's been with us for the last 7 years. Mina is included in the Lawyers Hot 100, so very, very well respected. Obviously, we're going to have to gear up with more capacity. So at the moment, we've got 262 live cases being well dealt with by the team. But with 2 new excellent insolvency litigators are going to be joining us in January of 2022. So that will give us capacity to increase to 400 live cases at any one time. So really, with a very small increase in overhead cost, so about £100,000 a head, maybe 125,000 with bonuses, etc. We increase the capacity of the business to handle the number of cases very significantly, given the redundancy in the model at the moment. And we have constantly been commended by the insolvency community and indeed the legal community. So for the first time this year, Chambers and Partners, the very respected global legal guide, did an insolvency litigation ranking, and Manolete was the only third-party funding firm that was rated in the treasured band 1 of that category. So that was tremendous to see. And for the 4th time in 5 years, we received from the industry the TRI Litigation Fund of the Year award. The only year we didn't win it was in 2018. It went to an international firm, and that's not Manolete's business. And this recognition is very important. The IPs, the lawyers, are heavily regulated, and they need to make sure that the cases where they're being funded, being sold, are going to highly professional and very well financed organisations. Usually Mark would go through the financials. What I would say is that these really are reflective, these latest 6 month figures, of the time when we were under the government's suppression of insolvencies. So that's kind of key point number one. So, and that really has impacted the lower unrealised profits that you'll see. Hopefully you can see my cursor, the 5 going down to 2.5, because just the volume of cases, new cases, has slowed down in that unusual environment. The other thing is the comparable period for last year, we had a discounted 9.5 million, I think it was, settlement of one very large case, which was a very exceptional result, as we said at the time. So if one strips it out, one gets a much more comparative view of the realised revenues of £7.7 million. So actually stripping that out is a much better picture. Administrative expenses, well, we've had some benefit from COVID, the lack of travelling to multiple events that the team goes to, and the costs of those events. So there's been a decline in the administrative costs. So on a net basis, EBIT has declined from 6.5 to 3. Very much in line with what the analysts were predicting for the company, and very much in line with our expectations. But clearly everything has changed from the 1st of October, and should be a lot better tailwind going into a more normal insolvency regime. Analysis there of gross profits, which again, really it's just the effect of the one large case last year, and then the lower level of new cases is really being reflected. Good to see that the margins are holding up well despite these extraordinary conditions, and also I think critically for us, seeing the number of cases being completed up about 23% from 52 last year to 64 this year. So that was good to see, and again stripping out the very large case, a good stable gross margin on those completed cases. Looking at the balance sheet, the investments in cases has risen, not as dramatically as last year, but we're still adding cases, net increase of 25 cases. The duration is still just 11 months. The cartel cases, we've again taken no uplift. The one area of one sector of cases are the cartel cases that have been affected by the court slowdown, and things have been slower in the Competition and Appeals Tribunal. So we've taken a conservative position there of not changing the valuation at all. Yet again, trade receivables again reflects the large case settled last year, which has a long payment period. Again, very exceptional, very much to support HMRC's desire to get a maximum return off that case. At the end of September 2021 reporting period, we'd used 11 million of our HSBC revolving credit facility of 25 million. So that still gives us 14 million of headroom. We also have on top of that a £10 million accordion that we could draw down if we so wished. But we're expecting there to be some strong cash receipts from previously completed cases and close to completed cases over the next reporting period or two. Cash flow. The numbers that really we focus in on for this reporting period, you can see that the net cash generated from cases strongly up to 2.8 million, and that strongly covers all the costs of running the business. So again, in these extraordinary times, to be showing a much bigger improvement on that, and a positive cash generation position is very good. So the only reason why we've increased our net debt is to fund these new ongoing cases, and given the returns that those generate, that's an attractive position, because we're borrowing at about 2% from HSBC, but our returns, as you saw, return on capital employed is well over 100%. So we think that's an excellent position for shareholders. I won't spend long on trade receivables. We've done this slide before. I think the most important thing really is this bottom slide. As you can see, the vast majority of our receivables are not due. We settle a case, as you saw in the worked example. We will have payment periods for a lot of those cases. So the vast majority is not even due. These few outlying points here is where they have one or two cases, they've broken their agreement, they haven't paid us. We've taken effective ownership of their houses and we are selling their houses, and two material ones going through a few £100,000 on each. And those should be completed in the very much foreseeable future. The reason for the profile here of the debtors, why they stretch over, is again back to that worked example. We settle for 150,000, paid very quickly. Another 50,000 isn't due for 6 months. Another 50,000 then until 12 months. Another 50,000 18 months. And again, we've got the coverage over their residential properties, and it probably won't be one director, it'll be multiple directors that we've got charges and restrictions over. Useful slide here, just comparing our realised profits to the cash that's been recovered. And obviously, the longer you go back, the higher the pink bar of cash received is of the total revenue derived in that month. And as I said in the previous slide, the blue bar doesn't mean it's overdue, it's just not due yet for payment in the vast majority of cases. That is it from me. We look forward to hearing from you in due course. Many thanks indeed.